Major institutions like JP Morgan are currently sounding the alarm. They are tracking a migration of global capital that is challenging performance benchmarks the US dollar has held for decades. Yet the average retail investor is largely ignoring these institutional warnings. Instead, they are pouring their savings into domestic index funds, like the S&P 500, operating under the assumption that the domestic market is a guaranteed safe harbor. This diagram reveals a vulnerability hidden within that index. Just 10 companies now represent roughly 40% of the entire S&P 500. This level of concentration means the performance of the entire market is now heavily dependent on a very small group of tech giants. Professional money managers at firms like JP Morgan and Vanguard recognize this risk. They are actively revising their 10-year forecasts to reflect a much slower period for US-centric portfolios. To protect your capital through 2026, you need to understand the data driving these revisions and look at exactly where these institutions are beginning to reallocate their funds. After World War II, the global financial system rebuilt itself around one core mechanism. To buy oil, settle debts, and conduct international trade, every country on Earth needed US dollars. This setup handed the United States an exorbitant privilege. Because the rest of the globe had a constant and growing need for dollars, the US could easily print money, run massive national deficits, and borrow at low rates without suffering the immediate inflation penalties that would typically hit other nations. That leverage was tested in 2022. Following the invasion of Ukraine, the United States executed a severe financial maneuver. They froze Russia's dollar-based foreign reserves. This decision sent a clear signal to every non-allied nation. If they stepped out of line politically, their own national savings held in US dollars could be restricted or seized. This realization accelerated the de-dollarization playbook. Foreign governments began a coordinated effort to build new financial networks that bypass the US banking system entirely. The coalition leading this shift, nations like Brazil, Russia, India, China, and South Africa, now controls 45% of global GDP by purchasing power. The Western Alliance, by contrast, accounts for 30%. Since 2016, the share of global reserves held in US dollars dropped from 65 to 57%. We see this clearly in China's data. Over 15 years, China cut its US Treasury holdings in half, dropping from 40 down to 20%. To handle trade without the dollar, these nations are moving to bilateral settlements. They're using new digital frameworks like mBridge to route payments directly between international hubs, avoiding American intermediaries. Simultaneously, central banks are stockpiling gold at the fastest pace in 50 years. They are prioritizing physical bullion because it is a hard asset that cannot be digitally sanctioned or frozen by a foreign power. These nations aren't looking for an overnight collapse of the dollar. Instead, they are deliberately engineering a dollar dilution, a gradual reduction of Western economic leverage on the world stage. This dilution is forcing major financial institutions to lower their long-term growth expectations for the domestic US stock market. This chart illustrates Vanguard's 10-year projections. Based on global shifts, they anticipate US stocks will deliver a modest annual return of 3.9 to 5.9%. However, projections for emerging markets are notably higher, with expected yields reaching 7 to 8%. This data suggests institutions are looking beyond domestic borders, identifying scaling international economies as a key driver for performance over the next decade. For individual investors, aligning with these institutional shifts involves a specific 5-step framework. Steps 1 and 2 involve ending a 100% domestic allocation. By adding emerging markets, investors gain exposure to the international growth that analysts at Vanguard and JP Morgan are prioritizing. Step 3 is to hold precious metals. This mirrors the behavior of central banks, using gold as a hedge to insulate a portion of your wealth from currency dilution. Step 4 is owning physical commodities. As international markets develop their infrastructure, the demand for raw materials typically increases, which can drive up the value of energy and industrial metals. Step 5 is to maintain a balanced partial exposure to the US. Despite the shifts, the United States still leads in deep capital markets and critical sectors like artificial intelligence. The transition toward a more diverse global financial system is already in motion. The investors who recognize this shift early will be the best positioned to adapt their portfolios for the decade ahead. To keep track of these shifts in the global economy, hit the subscribe button and drop a like on this video. And let me know in the comments, how are you diversifying your portfolio for 2026?